Welcome, everybody, this morning. It's glad to see a good turnout, both in person, and we know we've got a lot of people online as well. No better way to spend a late Saturday in June on a beautiful day than 3 plus hours talking about options. There's no place I'd rather be for sure, and we hope you feel the same way. So we've got a lot of material to cover for you today. As you know, at OIC, we're doing quarterly themes this year. We've been centered on selling options, receiving premium, and various strategies and concepts associated with that in Q2. We're wrapping that up here with 3 rather complex strategies. We're going to break those down into more simple strategies and construct those. There should be a lot of material, whether you're basic, intermediate, or advanced today, so we hope you enjoy it. My name is Ed Modla. I'm the Director of Retail Education for OIC. I'll be one of the presenters today. I also am very pleased to have Dan Kerrigan with me from NASDAQ, who's presented for us on a number of occasions. But for now, I will turn things over to Dan to kick things off today.
Welcome to the crossroads of America, where capitalism meets Broadway. I've got great news for you. I don't sing, so we're going to concentrate on options today. The title of this presentation, The Covered Combination, I like to call it my second favorite option strategy. My first favorite option strategy is the cash secured put strategy. And the good news is that my number 1 and number 2 strategies that I use as a retail investor are combined in this strategy. I like to call this, the covered combination is probably like the short thing that you can describe it, but I really like to call this the portfolio strategy. And I'll explain why in a little bit. But I think, as Ed said, we're here to talk about income producing strategies. And I'm just thinking that many of you follow probably a list of stocks. I know the gentleman came up a little bit earlier, showed me your top 10 stocks. We talked about it for a little bit. And I'm sure that in any stock list that you look at, you're probably thinking, hey, if this stock goes a little bit lower, I'd like to buy some shares. So you've got basically an idea. So how would you like to get paid for that good idea? That whole concept is wrapped up together in the covered combination. Or, in other words, the takeaway today is, why not get paid? So let's go ahead and dive in, but first take care of some very important business in terms of the disclaimer. That, as stated here, options involve risk, and they're not suitable for everyone. We encourage you to go to the website, optionseducation.org, to download the options disclosure document, the one that you received when you became options approved by your broker, probably threw away that big paper document, but there's a lot of good information in there in terms of description of how the products work, expirations, all kinds of things that are important for your educational awareness of options trading. And today's presentation has no mention of commissions, fees, or margin, and everything that we do today is a hypothetical example. So there should be no consideration on your part of a recommendation to buy or sell a security of any type. So thanks for your indulgence with our disclaimer. And I'd like to give you a quick look about the Options Industry Council, what we call OIC. I like to say that, in very simple words, we are educators. And that's why everybody has come here today, is to be able to satisfy education in terms of looking at options if they're right for your portfolio management strategies and, of course, your trading needs. Everything that we do today will be posted online. And I think more importantly, the optionseducation.org website allows you a repository of great training aids to go to at any time on your schedule, whether you are brand new to options, you're intermediate, or you are advanced. A whole slew of webinars, videos, and podcasts. So what else is OIC? We are made up of the 5 exchange operating groups that you see listed here. Of course, I'm with NASDAQ. We have our world-famous NASDAQ market site just at the south end of Times Square that I'm sure that you see with the markets opening and closing each day on the business channels. But you can see also the other exchanges listed: CBOE, BOX, NYSE, MyX Options. And at first, you're going to say, okay, how does this relate to me? 5 options operators? I'm a retail investor. What happens to my order? The good news also here is that your broker, when they receive your order, when you go to point and click, they're going to send your order to the exchange that has the best bid, of course, if you're selling, or the best offer in case you're buying. So your order always is going to the best market across all of the exchanges that are available for trading. So options have been on a tear. And I don't know how many hockey fans there are here. I'm a diehard hockey fan. We've got one in the back. You can see we made this chart for you, sir. This is an example of a classic hockey stick. Options trading began back on April 23rd, 1973. Just call options. Put options began a year later. And uptake began when the marketplace began to understand one concept. Options are the perfect tool for risk management, both by institutions and by retail. So you can see, marked by the exceptional growth of options over the last several years, this is a robust, vibrant market, one that is alive and well every day to serve your investment needs. So let's get back to the combination concept today in terms of what we're going to discuss. As I mentioned, this is a 2-for-1 strategy that you can take away today to assess if this portfolio mechanism is right for you. Combines 2 trades, one a classic covered call, and the other one is, again, my favorite, the cash secured put. We're also going to go through what your motivations are, and also importantly, actually I think big importantly, what the risks are. I think so often in terms of education, everybody is always focused on money, money, money. How much money can I make? And I am more of a risk-averse person. I am always focused on money, money, money. How much am I going to risk? That's of interest to me. We'll go through how to build the covered combo. And the good news is that all of you with online securities accounts have the tools in your hands. And the online brokers do a wonderful job of providing you with the ability to execute these various complex orders. Now, I know it's Saturday morning. Maybe one guy talking isn't like in monotone is not going to make the day. So I encourage you to stop at any point and say, look, please, I don't understand what you just said, or just as important, hey, how would this relate? Any question goes. If I can't answer it, Ed will help me answer it, but this is your time to be able to get an opportunity to ask questions that maybe you haven't been able to find with online resources. So first, we're going to take just a couple minutes to review the covered call. And I was curious, how many are familiar with the covered call in here? Okay, great number. A couple who are not, that's fine. The covered call is one of the first trades that retail investors learn how to execute when beginning on that trail for options education. And why? Because the concept is this is a trade less on speculation and more about income. Income is what's of interest to all of us, how to increase the value of our portfolio. And maybe we don't have a perfect view of where the stock's going to go, but we have a perfect view of what we are interested in, and that is generating income. So the covered call consists of 2 positions, which you can execute at the same time through your online securities platform, and that is the purchase of either underlying stock or shares of an ETF, and the simultaneous sale of a call just above the price where you purchase the underlying stock or ETF. Of course, which stock or ETF you choose is up to you, but it can be applied across the entire list of all the thousands of stocks and ETFs that are listed for trading in the national market system and have available for trading options. So in this example, we're putting up our favorite company today, XYZ, always the #1 company when it comes to OIC educational purposes. And we make the assumption that we're going to purchase 100 shares of XYZ at a price of $52, or in other words, $5,200 out of your pocket. At the same time, we're going to sell a call just above the market, a $55 call at $1. That'll give us $100 to put into our pocket. And in terms of how the profit loss looks here, all right, it's a chart. It's not easy to follow. It's simply to say that you have somewhat of an upside opportunity that will cap out, and you have a lot of downside risk. I'm not so hot on the charts going through in presentations. I think they are much better to pull these slides down at a time convenient for you and work through them, circle the areas to probably bring together the points of, hey, here's my break even, here's my profit. Let's go into the detail. So in terms of covered call, we mentioned that we're buying 100 shares of an ETF or 100 shares of an underlying stock, in this case, XYZ. At the same time, we're selling a call or going short. Your broker provides you a complex order ticket in order to provide you with the ability to do this transaction at once, usually as a net price. And you don't have to wonder, how am I going to put in the symbol of the stock? How am I going to put in the symbol of the option? They have the tools to pull down, usually, a strategy menu. And it'll say covered call, could say secured put, could say anything. But they will give you the ability to load that order ticket and then, of course, figure out which expiration makes sense for you to sell a covered call. So in terms of your maximum gain, you're looking at your strike price. We paid, if you recall, $52, and we brought in our pocket $1 for that call. So the maximum gain is that we're going to have the ability to take wherever the strike price is, up here, minus where we purchased that stock or ETF, and then we can add on to that the premium that we were able to put into our pocket. Again, all of this is with the assumption that we're not discussing brokerage fees, but those are real parts of any trading decision that must be considered in your trade assessment. Here's where I like to talk about risk, and that is in terms of where is your maximum loss. When you buy a stock or ETF, you don't assume it's going to go to zero that next day, but you always have the event that it could go to zero. So it's important to know before you go in, when you pull that money out of your pocket to buy the underlying stock, okay, you're getting a little money from the short call, but you do have the outright risk that that stock or ETF could go to zero overnight. That's the worst case scenario. Unlikely, sure, but important to know. Break even is simply your stock purchase price minus your premium received. And the strategy here is one of neutral to a little bit moderately bullish. I'm not sure if there's any analyst who comes out on the street here and says moderately bullish, but I think as retail investors we can. So they're either crazy bullish big targets or sell, one or the two. Volatility plays a role in every option strategy. Volatility is probably the most misunderstood part of options trading. I'm just curious, does anybody know what the definition is of volatility? You don't have to stand up and ask. Does anybody know? All right. I don't know if anybody has a stopwatch for 60 seconds. I'm going to teach you everything you need to know about volatility in 60 seconds. You'll be smarter than 99.9% of the people in the industry. So you ready? I don't know if you have a stopwatch, but here goes. Volatility measures the market's voice of the magnitude of the trading range that will take place over the next 1 year. Okay, what does that mean? That sounds like a bunch of double talk. Volatility measures the market's voice of the magnitude of the trading range over the next year. Another way of saying that is volatility is a megaphone. Okay, maybe that doesn't resonate as well. So let me give you an example, okay? Hi, my name's Volatility. My price is 10. I'm letting you know my stock or ETF is going to have a trading range of 10% down to 10% up. Not going to tell you which way, but you should know. Hi, my name's Volatility, and I am right now at 25. I'm telling you, you ought to take note because I'm telling you through my megaphone that the potential trading range over the next year will be from 25% down to 25% higher. Okay, maybe now you got to think about whether you're willing to lose 25% of your portfolio and examine types of hedging strategies. So that's one of the key takeaways of volatility. As it goes higher, it's telling you there's more uncertainty with the forward 12 months trading of that stock. I know I went longer than 60 seconds. I hope you don't penalize me for that, but I think it's important to understand volatility when you get in and not leave it to the sidelines. Well, if volatility is the megaphone that is sounding the warning sign of potential storm clouds coming, time decay is the opposite. Time decay is your friend. Each day as you march forward to the expiration of an option, the consideration by the marketplace of that value of that option starts to go a little bit lower, 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 lower. And when you sell an option, you want time decay on your side. It's your best friend. But in terms of a covered call, your biggest risk here is that you might be assigned. But going into this trade, you said, look, I bought the stock, I'm selling a call. If the market goes up, I have limited upside, and I'm willing to depart with the stock. So that's the covered call review. Let's go into the cash secured put review. My favorite trade that I do I call it 50 days. That's my favorite time frame. The reason why I say 50 days is because at the start of an option cycle, you have 30 days plus usually 15 to 20 days before the next expiration. So I like that month and a half cycle. So I'm just asking everybody here, are you happy with interest rates on your money right now, like you have in the bank? Anybody? What, sir, you're not happy? You'd like more, right? All right. Let's say you got some cash. You got to make a decision in terms of what to do with that cash. You can put it in a T-bill right now, maybe get 2%, the 90-day T-bill. But I like to look at cash deployment in a much different way, and that is deploying a cash-secured put strategy, which is simply selling a put on a stock or an underlying ETF. Remember what I said at the beginning? Hey, what if you had an idea that you would love to buy a stock a little bit lower? I see some coffee cups here from maybe our favorite coffee store, Starbucks, and maybe you're thinking that might be a target stock. You might think of some of the other stocks that are out there, like I see Apple Computers. I know you're running Microsoft. Would you have an interest in buying any of those stocks $10 lower? If you think that's something you'd like to do, why not get paid for that idea? By selling a put gives you that ability to do so. In this case, we use the example of selling an XYZ 50 put at $1, and we do that, but it requires one thing, cash. You have to have the entire amount in case you have to buy that stock at the strike price, or in this case, essentially $5,000. Here's the chart. Gives you, yes, sir, please.
When you buy that $15 put, what is the price at that time?
All right. So we're selling a put in this example. The price is dependent upon the strike that you choose and in which month. So as you go further out in time, the presumption is the prices of those puts will be higher because there's more time till expiration. But you've identified probably one of the greatest challenges as to making a decision in these strategies. What's your time frame? There are weekly options. There are monthly, which we call standard. You can go out 3 months, 9 months, and leaps. So the choice is yours. And that's one of the factors that need to go into your consideration for risk and reward. Does that help explain? All right, thank you. Please, go ahead.
Why do you prefer cash secured instead of having the stock?
So cash secured puts is basically a proxy for investing cash in a certificate deposit or a money market fund. Now, you've identified another very important point here. You have a choice. Do I want to always have cash and the potential to own the stock, or do I want to own the stock and get the dividend? These are decisions that have to be made that come into your decision making. It's not easy, but it's also a question of what is it that you want to achieve in your investment horizon? It's a great question, thank you. And I'll lead into basically the requirements of the cash secured put, is that we said we're short one put, and that basically means we're long cash. We had to pony up all the cash that would require buying that stock in case that put is assigned to us. Now, the maximum gain here is limited to the premium that you take in for the put in case the stock takes off and you never get assigned. That's okay. You get that money in your pocket. You're happy you did it at the time. But in terms of the strike price, you get back to, or the risk, you get back to the same issue of what happens if the stock goes apart overnight. You are obligated to buy the stock price at the strike price that you sold the put minus the put premium, and that's the risk going to zero. So, you have now kind of a little bit of a difficulty in terms of your forecast. Short term, you're a little bit bearish. You'd like to see the market go down a little bit in order to perhaps give you a higher premium to sell this put. Maybe you'd like to see it exercised to be able to buy the stock. But long term, you are generally bullish. And if there's any one thing you take away from this strategy today, not just the cash secured put, There is a whole element of neutrality which we'll go into, but I like to call this my portfolio management when I am generally bullish. And I am always bullish on the stock market over time. This fits my risk horizon for what I like to do. Volatility in this case is slightly negative because an increase in that megaphone of volatility can make it more costly to buy back the put in case you need to get out of that position for some reason. But you still have the friends of time decay. And as we said, market goes down, you're going to get assigned. But let's go ahead and build now the covered combo, and let's see how it might help for us as retail investors. Let's put it all together. Either you come into Monday morning owning shares of an ETF or stock in your account, 100 shares presumably, or you decide you want to identify a stock or ETF and buy 100 shares. At the same time, you're going to sell a call. And remember, your broker will provide you the ability to do that as one seamless trade in a covered call trade. So coming in, we're buying stock at this price. We're going to sell a call up above the market. At the same time, we're going to sell a put below the market. I like to call it our three-legged combo. Wait, 3 legs into a combo? All right. I like to look at this as the covered call is one strategy, even though that's 2 in 1, and the put is the third part of the 3-for-1. Going to have cash in your hands to make this work. This is not a leveraged play. And your attempt here will be prefaced on this. Hey, I like this stock. I got it now. I'm going to sell a call because I'm moderately bullish over time that it's going to go up, but not go through the moon. But if that doesn't work out because I'm not perfect in my analysis, I don't know how many of you are perfect. I'm certainly not. But I love having the optionality that if the market goes down, I am absolutely happy to buy another 100 shares of that stock or ETF. I do this, again, every 50 days on one stock that I love to do, that I will own it and keep buying more whenever I have the chance. That's what works for my risk tolerance, my risk horizon. But again, it takes cash in hand to make the strategy work. So please, go ahead, sir.
The put will allow you to acquire the stock, the ETF.
Additional shares, that's correct.
The call is going up.
We're going to cover that in just a bit. The short answer is that if the stock increases in value, the call will be exercised and it will take away 100 shares of your stock. So you have basically a cap on your upside. But that's a great question. Thank you. And that goes into this slide in terms of the risk. The worst thing that can happen is this stock washes out and goes to zero. I mean, that's for sure. You own 100 shares, stock goes down, your put's going to get exercised, you're going to own 200 shares. But it does offer some offset from that type of risk with the premiums that you're taking in from both the call and the put. But this idea, sir, that you just asked me about, early assignment, it could take away your stock just like that. You know, maybe the company gets bought out and it's soared 100%. You won't be able to get that upside. But at the time you enter the trade, it looked pretty good. All right, let's put a plan in action and see if we can relate to prices on the screen that might be of interest in terms of once you get to Monday morning, you fire up your online retail broker platform and look perhaps to do this combination trade. Up at the very top, our beloved stock XYZ is trading at $52, and it's been in a range $44.80 to $58.25, so pretty wide range for this. A lot moving on. So you're going to look in terms of where is the options market at this point. So our example is that we've bought 100 shares of XYZ at $52. We're going to go ahead now and sell out in time a August 55 put. The assumption is we're early July, and as of tomorrow, we will be early July. So the ability to sell an August call means I've got basically 7 weeks for this call to be in action, but also I get the benefit of the value of a call for 7 weeks in terms of its time premium. So I'm going to sell that call for $3.60. That's mine. That goes into my pocket. Actually, it goes into your pocket. And at the same time, I'm going to sell a put, and that put is going to be below the market, and this is going to also be for the same month in August, a 45 strike put. And that's, please, go ahead.
That means you're going in the money
You will have,
when you sell the put.
the put is, that's a great question. The question was, are you selling in the money? So let's reset where we are with the stock. The stock right now is at $52. So you're going to sell a call that's out of the money at $55, and you're also going to sell a put that is out of the money, that is down here at $45. So both the call and the put are out of the money. That's a great question because that's the only way the strategy can work. So let's see what that will do for you in terms of money. Selling both that put and call will add up to a net credit of $5.55. So with a $100 multiplier, you get $555 credit to your account, of course, before brokerage commissions. But again, as we said, that example of, hey, if I have a choice to put cash into a money market fund or into an option strategy, how much cash will I need to have for this? What is my broker going to require of me? Well, they're going to require money to buy that initial 100 shares of stock, $52. So you know you got that coming out of your pocket. But they're also going to say, look, you're selling a put at 45. If you get exercise, you have to buy 100 shares at 45 or $4,500. So you need $4,500 cash on hand in addition to the initial for the stock and the call. We'll go through the exact amount of that in a second. But let's look at the gain here in terms of what could happen. That call strike is at $55. So you got into the stock at 52. So if the stock goes up, you're getting $3 in your pocket. And you already got net premium of $5.55 that you're able to put into your account. That adds up to $855 or $855. So let's think about it. 7 weeks, $855. I got about $9,000 tied up. Pretty substantial percentage as a return on capital, and I guarantee you it's a higher rate of return than in your basic certificate deposit or money market. So the gains are, however, limited, as we just said, and that's because of the short call effect that you kindly brought up. But let's now look at the put. So now we have the stock on hand. Again, this is the trade setup, the exact same information at the top. Let's now look at the maximum risk that we have here. Okay, we bought that stock, remember, at $52. We also have that put strike at $45. That's where it's going to require us to buy another 100 shares. So we're going to add those two together, the 52 and the 45, and we're going to subtract the premium that we took in, $555. You don't have to do any math. This is the good part. It's all right here. Here is your net, your gross out-of-pocket risk if this stock goes to zero, $9,145. All right, how do we get there? Once again, we were able to buy stock outright at the beginning of this strategy, and we sold a put that became exercise. So we essentially now own 200 shares. So $9,145 that we can target. I don't think anybody here goes into a trade and goes, I'm ready to lose $9,145. You might have a different risk profile, and that's one of the best parts of the combination that we'll go into in just a little bit. So what happens at expiration? This is the best part. You got a lot going on here. Once again, you've got two positions. Remember, you have the long position at $52. You've got a short call at $55 and a short put at $45. 3 for 1, 3 open market positions. As we talked a little bit, your upside profit potential is really capped. If this company gets bought out, if it gets bought out $100, you're obligated to sell at $55. That's okay. You were willing to take that price when you came into the market. And we just mentioned what happens if the stock goes down. You're going to have to buy another 100 shares at a strike price of $45. So the chart here looks like almost like a bow for a violin. And that's because as it goes down, you hear the drama of losing money. And as it goes up, you have the drama of not making the most amount of money. But I like to say the output of any opera is happiness in terms of being able to define on your terms your risk and reward. So we just mentioned in terms of having doubled up on the stock. So let's now look at examples of what happens when the market moves to certain levels. I got bad news for you. Your great idea on XYZ didn't work out. It went down. But hey, wait a minute, is that bad news? You came into this strategy and you said, I am willing to buy more shares of XYZ if it does go down. So now you've actually fulfilled perhaps one of your ultimate goals is to get more hands on the stock. So if it goes below 45, the short call that you sold is gone. You get to keep the money. But that short put is a sign. And the gentleman that asked up front what happens with that short put, it's telling you, you got to buy stock at 45 bucks. So you purchase 100 shares, and now you own 200 shares of XYZ. So what is now your new purchase price for this assignment? So remember, at the very beginning, when you sold that call and you sold that put, you took $5.55 of premium and put it into your pocket. That's yours to keep. So you were at a price then of $52. So now you have a credit that comes down to 45 minus that net credit. Your price now is $39.45. You have lowered your cost basis to own this stock. All right, does that make sense? Yeah. So let's go a little bit further and see how this makes sense in terms of the 200 shares. I don't know about you, but I like to go to stores when stuff's on sale. You got the holidays coming up. Every store is going to come at you. I got the 4th of July special, and I told you about fireworks. Here's the fireworks idea. Things didn't work out in terms of your goal to be moderately bullish, but the stock went down. Now you got a chance to buy it and average down your price, if that goal is suitable for you. So the math at the very bottom of the page is actually very simple. Your price here, the initial shares you bought at $52, you own 100 shares there. Your adjusted price of your second 100 shares is $39.45. Add those together and divide by 200. Your now average long price for these 200 shares is $45.72.5. So you started in this. You love the stock at 52. Do you like buying it on sale? 45? That's a better deal, right? If it doesn't go to zero, it's a better deal. That's important on the risk. But here's an example of things didn't go well. What's the benefit to you as a retail investor? You had an idea at the very beginning. I would be willing to buy more shares of stock if it went down. Why not get paid for your good idea? That's what the options market provides you in terms of opportunity to exercise your various portfolio strategies. All right, let's take a look now at what happens between $45 and $55. You can see now the violin bow gets a little bit wider. But here's the good news. You sold a 45 put and you sold a 55 call. You're in between there. Nothing's going to happen. They're going to expire worthless. So you get to ring the register. You get to be the house and keep the money that you sold at the very beginning. Yes, please.
I have a question on the put. Assuming that, do you have to buy that back for a nickel or to buy to close, or does it just actually expire worthless?
I'm so glad you asked that question because it's one of the things that we don't put into this presentation, but it's hugely important from a risk perspective. So the question was, hey, what happens to that short put? You sold the put at $1.95, and now you're getting close to expiration. What happens? I'm going to just, if I could rephrase the question, what happens at expiration? You have two choices. If a day or two before expiration, the stock is trading, let's say it's at 47, and you sold the put at 45. You might go, hey, I'm worried in the next 2 days there's some event that could happen to the company, and the stock could go whoosh and make me buy the stock. I want to buy back my put because I see on the screen the offer is at 5 cents. You can absolutely offset your short put by buying that put back for 5 cents. Your account now is flat. You have no risk of buying the 100 shares. But the second part is if the stock closes just above 45, that put expires worthless. Nothing happens. You don't pay any commission. Your broker says, thank you very much for trading. You get the full credit of the put minus the commission at the beginning when you went into it. So thank you. That's a great question. Yes, sir.
Just following up on that, being that both options are out of the money, and and they're 7 weeks to expiration.
Right.
So therefore, they have a lot of extrinsic value. Let's say the stock remains range bound, like 4 weeks. Would you buy, then you'd probably could capture maybe 50% of both premiums, buy to close and reset the whole thing?
Sure. Great question. So let's say time marches on and your stock is what I'm going to call a big yawn, which is okay because you're short options. So you like the fact that every day when the stock is yawning, that the marketplace is saying, this option's less valuable, this option's less valuable, this option's less valuable as it goes through. So let's take into account, you took in a total of $5.55 credit here, $555. Let's use your example where those options now have decreased in value by 50%. There's nothing that prevents you from buying back in those options and banking that profit. So if I could use simple math, let's say you sold the premium at $6 and now you could buy them back for $3. You'd have a $300 profit. That's great money in, 3 or 4 weeks. And that gives you another area of optionality that's great about the combination. You are not married to this through expiration. You gave a great point. Can I help reduce my risk by buying back an option a couple days before expiration? Can I take some money off the table? Maybe I have 10 puts on. I want to buy back in 5. All kinds of optionality here, but you're correct. The decision is yours. It's important to keep in mind every time you make a trade, you will have commissions involved, and that should be a part of your trading decisions. Great questions. Yes, ma'am, please.
To follow that point, isn't that called rolling?
Rolling would be if we get close to August and nothing happened and you decided, hey, I want to move these options out to September. You'd buy back your August options and simultaneously sell September options. So great question. It's another very interesting twist to this strategy that you can do. Time is also opportunity. Yes, ma'am.
Do you always go out the same time for calls and puts?
Yeah. Yes.
And you go 1 month out for puts and 2 months out, somehow different timeout?
I love your question. The question was, hey, you gave an example where you're selling both an August call and an August put. Could you do it with different months? Could you sell an August call and a September put? And the answer is absolutely. It's a matter of what your time horizon is for this strategy. We used 1 month to make it simple, where in and out and what happens between now and then, but absolutely. And the benefit, if you are willing to buy shares as the stock goes down, the benefit by selling a farther out month is that you'll get a higher premium, so more money in your pocket. That's always a good motivator.
How far do you go for your?
I'm always 50 days. 50 days is what works for me and my risk tolerance.
That's the minimum, 50 days?
Well, that's what I like to do. You could do this with weekly options, 1 month, which we call standardized options, 2-month options, 3-month, 6-month leaps. It's all dependent on your time horizon. You could go for a year out and have a set it and forget it strategy. And if you buy more shares, you can do something different. Yes, sir, please.
Yes, which are some of the best instruments, like ETFs, to do this strategy?
Sure. Well, every option that is available for trading in the marketplace is a suitable candidate. We can't give any direction, but I think by going to your brokerage firm website, they're going to give you a list every day of the top 100 most voluminous traded options and stocks. I think that's a great place to look, because that will give you where is the most activity, and then allow you to be able to assess, do I want to go into a broad-based ETF? Do I want to go into a single stock? These are big decisions on your part, because when you go into an ETF that's broad-based, the entire market, like the NASDAQ 100 tracking QQQs, you got 100 stocks. But if you just go to one stock, now you have single stock event risk. So it's up to you on that. Yes, sir. Thank you.
So another good aspect of this strategy-wise would be for a stock or an index that's traveling sideways.
Yes.
You're interested in collecting premium.
Yes.
You get a range-bound stock or index that's just going sideways.
Correct. So the question was, would this strategy work for a range-bound strategy, whether it's an index, an ETF, or a stock? And the answer is yes. We like to call it moderately bullish, so I'm not sure if that's the right way, so I'll go like this. But But you're correct. Thank you for that. We just went through what the upside was of the call. Yeah, you're going to sell your stock at the strike price of $55. But look, you got to keep that $5.55, so now you got your $60.55 gain. So we're going to go now into kind of a twist, and then also ask the questions online to bring them forward, and we'll keep going through the different scenarios. So I'm going to go back to, ma'am, you were great in the front row asking a question about in this group in terms of all types of optionality. Let's say this strategy just wasn't perfect in the way you see the world. And it's not perfect in the way you see the world because you go, I don't want to do everything at once. I want to do things in halfway at a time. The decision of trade entry, the decision of trade strategy is always going to be up to you. So here's an example of one of my favorite people in the world. Please come on in. One of my favorite people in the world is Leisha. And she's got a scenario in her mind she's trying to sort. She says, I have been saving money in my IRA for the last 3 years, and now I have a stock that I am really, really liking, but I don't know how much I like it. So I've got to take a decision to see what I could do. So here is an example that we thought would be of interest to present to you so that you could find what we like to call wallet sizing. I don't know about any of you. I don't have all the money in the world. Maybe some of you do. But I try and find a strategy that fits what I have saved in my IRA, something that works for me. I like smaller capital outlay strategies because I am super risk averse. And that's why I like the covered combination so much. So an example here, Leisha decides, hey, I like the stock. I think I'm going to see it go a little bit higher over the next 3 months. And I'd like to buy 600 shares. And at the same time, I'm going to sell 6 calls against it, garner a little bit of income. But she's not sure if the stock's going to go up. But if it goes down, she's going to be pretty happy. And she says, this is another way to get the stock on sale, is to reduce, actually lower the cost basis. So her broker says, hey, you got a couple ways to go. One that's not on here is you could buy the 600 shares of stock. Money's out of your pocket. You're going to hold it forever. You're going to hold it for a month. You can hold it for whenever you want. But here, in this example, there's 2 scenarios that we put forth. You could buy the 600 shares and sell 6 calls, the covered call strategy, or you could look at splitting the idea in half. Let's buy 300 shares and sell 3 calls. That's that covered call strategy that sits right here. And at the same time, we're going to sell 3 cash secured puts. So we're going to need cash on hand, as we said at the very beginning, to buy those additional 300 shares if the market goes down. So in terms of what we've put together today, in terms of going all in on the strategy of the covered combination, I'm just curious, does either one of these options stand out of interest to either one, anybody here, number 1 or 2? Sorry, what's that? Like number 2? Anybody else? What you got? Sorry, go ahead. Just yell it out, sir. Go ahead. Number 2, what about you? 2? Anybody for number 1?
It depends.
Okay, why do you think it depends?
Depends what you think is going to happen.
Exactly. That's the hard part here. This is the thing that we want to bring away today, is that this is one facet of education. This is a strategy that you can deploy. But at the end of the day, the strategy is based on your view of the stock. Sorry, was there somebody in the very back? Do you have a number 2 or 1? Anybody else? What do you have? Yell it out, please.
I think number 1 is a possibility depending on the compliance department of your company.
Ah, great part.
Allow short puts in an IRA account.
Yep.
Usually requires a market premium.
Great question. The question was, hey, what about the compliance in terms of your either company or your brokerage account? You have an IRA. Are you permitted to sell puts? Maybe you can't do it. Well, in terms of options accounts, everyone has a different options approved level. And it's up to you to discuss it with your broker in terms of their assessment and, frankly, your assessment of your risk tolerance, whether you qualify to sell puts. Because when you sell puts naked, you have to have 100% of the cash to back up those puts in case the stock goes down through that strike and forces you to buy it. That is a great question. I should have said that at the beginning, that it's not a fait accompli that everybody can go in Monday morning and go, sell puts, sell puts. You have to see at what level you're approved by your options broker, but they're there to help you. If this is an idea, you can pull it down from the website and say, look, I want to do this covered combination. Am I approved? And if they're not, they're going to ask you. We need to ask you now what your risk tolerance is. So you can definitely have that discussion with your broker, of course, if it makes sense. Thank you. Really, really nice. So you, sir, are the lone. You're number one. Everybody's number two. So we'll have to see if there's a perfect outcome here or not. So let's go a little bit further. So Alicia, my best friend in Chicago, she sees the shares trading at $77, and she thinks there's only going to be an increase of roughly 5% over about the next 90 days, over the rest of the summer into just past Labor Day. So she decides under number one to buy 600 shares at $77 and sell 6 of the 90-day 80-strike calls. And here's a good example, what you had mentioned about the timing of strikes. We've been talking about 45, 50-day calls and puts. Here's an example of 90 days. So that premium, $2.34 for a strike of 80 will represent a lot of time, higher premium. Or we can go to the crowdsourcing number 2 of buying 300 shares of that stock at 77, selling those same 3 90-day 80 strike calls at $2.34. And at the same time now, we're going to do the covered combination. We're going to sell 3 of the 90-day 75 strike puts at $3.05. So the question always comes, are we at the Kentucky Derby? Is this a 2-horse race where there will be a winner and a loser? And I can tell you the outcome right now is there is no winner or loser. The only determination of success is whether one of these 2 strategies meets your risk tolerance for your portfolio management goals. So here's the outcome. Just the covered calls. We bought those 600 covered calls. Got to take a lot of cash out of your pocket, $44,796. I mean, that's what you got on the line if that stock goes to sleep overnight. But your reward now, if the stock goes up to 80, remember we sold a 90-day 80 call. We're going to get taken out at $80. Plus we got that premium. So our maximum reward, $3,204. It's pretty good, right? $3,204 was about 8% return in 90 days on $44,000. That's pretty good. But let's look at the covered combo. Here we go with the 2-horse race. We bought those 300 shares at $77. We sold 3 of the 80 calls above the market at $234, and we sold 3 of the 75 puts below the market at $305. All right, so now what's going to happen? How much money do we need out of our pocket? We only bought 300 shares, so we only need $21,483. But remember, we're selling 3 puts. We need all the money to buy those 300 shares in case those puts get exercised. So the maximum risk now, $43,983, just a little bit lower, not like night and day. But now look at our max reward. Our max reward under the covered combo is also less compared to the covered call, okay? But let's look at our break even. Our break even now is if the puts do not get exercised, $71.61 on those 300 shares. Much different than the break even of $74.66 on the 600 shares. Remember the idea I said about buying things on sale? You sold something to buy something on sale, gave you a lower price. Now we have to buy those puts. Yep, my average price is going to go up because I had to pay the $75 for it. So now, owning 600 shares at a price of $73.31, it's still lower than my cost basis on the covered call. Is it good? Is it bad? I don't know. That's up to you to decide. But we know one thing. If this stock takes off and goes above that $80 strike price, Our maximum risk, in this case at $83 for the example, not as much as the covered call strategy, but the profit and loss here still is up to you to decide which is better, which is not. So this is the twist of all of these trades. And I know there's a lot going on in this slide. We're combining the averaging of shares on the down move for the puts. But let's look at that down move. Everybody likes to talk about money, 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 making money. But few people want to talk about what I like to say, money, money, money. How much money am I going to lose? The covered call, as you can see, much lower out-of-pocket risk here. And, well, again, that's a decision point on your part. Do you want to own that stock or not? So I'm going to move forward and encourage you to pull down this presentation once we're done. It'll be posted later on the website. But of a quick recap, this strategy is neither bullish or bearish. Sir, you gave me the great thing. This is range bound. I now got my direction. Range bound to a little bit higher. That's exactly what this is. And can be done, sir, as you asked. Can be done on any stock or any ETF. Up to you. We always say you have optionality in the options industry. The objective, though, is that you will be able to buy more shares below or sell them above where the market is. The idea that you can buy a stock on sale. Why not get paid for your good idea to buy more shares? Income. The fireworks of this presentation are that this should shed light on the potential for income versus trading, making a decision, stock up, stock down. What's your long-term view is what I like to say. And, of course, you've got substantial risk. You own this stock or ETF, it can go to zero. That's a reality. Got to look at that, got to keep in mind. Do you have that risk with a broad-based ETF? No, maybe not so much, but you sure have it with single stocks, but important to take in. And if the stock goes up, they're going to take away your stock. It's going to be an early sign. They're not going to let you hold on to it if the stock has doubled in price. And of course, volatility. The market's megaphone, if it starts to shout louder at you, will have a negative effect, but it'll be slightly negative. It will get back to the scenario that if you want to buy back the puts in either one of the scenario, they may be higher in value. And you might say, this stock is going down hard. I got to get out. And you will have to pay the price of the put plus now the increased price of the put because volatility has gone up. Just remember that megaphone. Market's screaming. It's going to say you got to pay when it's screaming. But the passage of time's your friend. And we have the summer breeze blowing outside here in Times Square. So time decay is always a great attribute to have. So we're going to go through just to see if there's any last minute questions, and we'll go. Please.
Yeah, since you're selling, implied volatility should be your friend.
So,
Because higher implied volatility means higher price.
so you asked a great nuanced question, and you are absolutely right. At the point of trade entry, if volatility is higher, you will have a higher premium that you will sell at the option. But over time, you want to benefit from decreases in volatility. If where you sold that option, the price volatility goes up, and assuming the stock goes sideways, that option will increase in value that you have to put back. So definitely a good point. Always kinds of things of optionality and volatility. And we're at the end of our time, so we'd love to continue the conversation with you. And we'd also ask you to go to optionseducation.org. We have an email address. We can go through all these scenarios for you. But we want to thank you for coming to the center of Americana here in Times Square. Wishing you a great Independence holiday. And thank you for looking at the covered combination for your portfolio today. Thank you.